Social media interactions become interesting only when it is two-way. You must get a fair chance to interact with the person you follow or the person whose videos you watch. I have started this new initiative, Ask Milestones to Wealth Anything, AMA in short, through which all of you can stay in touch, ask me questions you like to ask, clear your doubts on personal finance, learn more about Milestones to Wealth and about our PMS products, and stay connected. So, this brings us closer. I'm able to be closer to you, to help you in whatever way I can. You feel closer by asking whatever you wish to, and we grow together, helping each other along the way. So fill in this form and stay connected through Ask Milestones to Wealth Anything. Mutual fund investing is a subject very close to my heart. It's a space which I have watched very closely from 1993 when private mutual funds came into India. I have been very observant of this space, often very critical of it. But post 2008, I made a very decisive shift towards being more objective and finding what is good and what can be better. When I started doing this, I started seeing the power of mutual fund investing, how it can transform the lives of a person who is middle class, who is going to rise all the way up into upper middle class and beyond. So this transition is something that I have seen as possible through the mutual fund space. I consciously chose to be into mutual fund research, into which I have been deeply engaged with for over 16 years. This has taught me one thing, that the funds which people buy are more often the funds which should not be bought. That's a sad irony, because popularity of a fund often creates excessive flows into that fund, leading to slack in investing. And only when the slack is taking effect and becoming a problem, the fund receives maximum flows. This is my observation of the Indian mutual fund industry over these 16 years. And what happens is the fund starts underperforming after that. So actually, the investment experience of more people in that fund is bad. I'm sure this applies to other product categories like PMS also. But in mutual fund, it affects a middle class person, a salaried person who's saving for his retirement, for his daughter's marriage, son's education, for his travel in later years, for his parents. So the money is being purposed towards time-bound financial goals. So for such a person, it's something that should not happen. In my view, this should be avoided. How can you avoid it? You can only avoid it by not buying funds based on their recency of performance or by past performance that is not supported by the present portfolio. So these are things that one needs to do. As an investor, I would always do this. Even my own portfolio, when I look at it, I will ask myself a question, is it as good as it was before I started the market cycle or before it performed exceptionally well? So after performing exceptionally well, is a portfolio still good enough to perform? That's the simple question. But that question is often not raised in mutual fund investing because you're looking at past data and making up a decision and contributing capital often in very large sums. Rarely do fund managers actually live up to that confidence. Rarely. Almost universally, fund managers struggle with large portfolio sizes. So there has to be a different approach to mutual fund investing if you have to win in it. What should this approach be? Start with the present portfolio, the current portfolio, build conviction on that portfolio, see whether that portfolio is good enough to deliver future returns. Put all the past performance behind. This is like a cricket test. It has to be played for a reasonably long duration. But you bet on the player based on his current form. You don't see statistics and then pick the player in the 11. If he is having very poor form currently, then you have to pick the player in current form. Only then you will win the test match. Am I right? This applies to mutual fund investing. Yet, we go by statistics, past form. Look at him, he's got so many centuries, his average is so much. But that doesn't help. So you have to start with the current portfolio and see whether the current portfolio will win. Suppose I am given 100 current portfolios, I'll pick the portfolios which I think will win from here. It doesn't matter what happened earlier. Yeah, that's all history. It's like pedigree. Yeah, you can keep it in mind. But you can't use only pedigree to bet on a mutual fund scheme. You have to bet on current form, current portfolio composition, and the capacity of the current version of that portfolio to deliver into the future. This is the only way that one can succeed in mutual funds. But that's not what people are doing. That's why a lot of people fail. And when they fail, what alibi we start getting is that, oh, managers won't beat index. So let's go into index itself. Or, oh, we don't need an advisor, we can do it on our own because anyway, nobody knows how to buy the right product. Then the third thing which is raised is, how can you tell which fund will do well in the future? Nobody knows how to do it. Now, all this comes from a lack of appreciation of fund research, how it should be done, how it has been done in the past, what are the fault lines in our past fund research, and what should be the futuristic approach. Now, what I am saying as an approach was probably futuristic in 2008 when I started it. Today, I won't say that it is futuristic. Something else has to come. So, you need to be forward-looking and futuristic in mutual fund research and advisory and in investing, and not driven by the past performance. If you're going only by the past performance, chances are that in many instances, you will fail. Now, suppose you have bought 7 funds or 5 funds or whatever. Let's say 5 funds. All on past performance. 1 or 2 managers will still do well. The other 3 won't. Overall, your investment experience will be mediocre. Now, what should you actually be doing? I feel that you should ensure that you don't pick those wrong managers and you pick the right managers and the right products. If you do that, all 5 will succeed. Saying that I can't do this, therefore I am going to the index is essentially lowballing oneself. I don't have an objection to it, but I wouldn't do it as an investor and I wouldn't want those whom I care about doing it. If somebody asks me genuinely for advice, I'll say, boss, don't do this. Why do you lowball yourself? Instead, find a way. There is a path. When you find that path, then you are going to never miss the woods for the trees. Remember, what we are doing in mutual fund investing today is completely missing the woods for the trees, confusing past performance as a reliable indicator of future performance, mixing up costs with investment research needs, confusing options, regular and direct, with what kind of behavioral emphasis you need in your investing through mutual funds, and not achieving what we can definitely achieve in our lives by investing through mutual funds. As somebody who has done this for 16 years, reasonably consistently for thousands of people, I can tell you that if people understand this well, then their experience in mutual funds will be far superior than those who don't respect these aspects and get obsessed about the lesser aspects. If you can see the woods clearly, then you're not going to worry too much about the trees. Thank you for watching this video.